Welcome to day 3 for ACCA paper Financial Management. This is your instructor RIZWAN MANIYA, and we will be starting our session for today. So first of all, the quick guideline to remain connected. If you are new to the session today, just send me a quick WhatsApp message and I'll send you the group link as I've done for the previous 2 days. For this webinar, this is the chat box, so remain connected and you can ask questions, you can reply me, whatever I'll ask you. Day-wise plan, we are done with day 1, day 2, and now it's day 3. Today I'm targeting business finance, leftover area, okay, and risk management for this 3rd day, okay. Let's begin with business finance. As I told you earlier in the previous days that VAC is basically part of business finance. We've covered VAC separately, but there are other areas that are also part of business finance. That includes dividend policy, that includes financial ratios and sources of finance, okay. So VAC is one portion that we have covered. Now let's begin with the other areas. So as I mentioned that VAC is part of business finance, and we have already covered VAC before. So let's begin with business finance areas, the remaining ones, and the most important of that is sources of finance. So I must say theoretically you should be really good in these 2 areas. Sources of finance basically includes the traditional sources of finance, and then you have Islamic sources of finance. So the traditional sources of finance includes 2 groups. One is equity, okay, equity, and second is debt. One is equity and second is debt, okay. So you should have a very good knowledge and understanding of these sources of finance. Let's begin first with equity. So there are 3 basic major sources of equity finance. The first is retained earnings, second is right issue, and third is new equity issue. Now before I move towards today's question, which is a very important question, and you will definitely understand the way I'll just solve the question today, will make it really easy. Before I move towards that, a quick review of the theory. Retained earnings basically represents the internal undistributed profits available to the shareholders, okay. So you can use retained earnings whenever you want to as a source of finance. You don't have to ask anyone. But the only thing to consider is that if you use retained earnings as a source of finance, this will have an impact on your dividends. Your dividends will be suffered, okay. So if you are sure that your shareholders will not protest if you don't pay them the dividend, then you can use retained earnings as a source of finance. Then you have right issue. Right issue basically is something that you issue the shares, the new shares, but you issue the new shares to the existing shareholders. So this option is only available for existing shareholders, and you offer the shares to existing shareholders at a discount, okay, at a discount. So when you issue this to the existing shareholder at a discount, they have this opportunity to avail the shares at a discounted price which is lower than the market price. So for them it's a good attractiveness, and they can buy the company's further shares at a discounted price. But this option is only available to existing shareholders. One term which is very common for this topic is theoretical X right price. You can see here TERP, theoretical x right price. Now you need to have a good understanding about this term, and you also should know how to calculate. So we'll calculate today. But as a concept, what is important is that TERP or theoretical x right price represents the share price which should be theoretically right after the right issue. So according to theory or theoretically, this should be the price of share after the right issue. So TERP represents that share price which should be the price right after the right issue. Okay. But for TERP, it's important that all the shareholders will take up the right. So the assumption when you are doing the TERP calculation is that all the shareholders will take up the right. It's a very important assumption. Once you calculate TERP, this is the mindset, this is the assumption that is kept in your mind that everybody will take up the right. Okay. So this is basically theoretical x right price. Okay. The third is new equity issue, which includes two further subcategories. The first is known as placing. Okay, it's placing. So these points are for placing. So what placing is, that you sell your shares privately to a small number of selected investors. You are selling the shares to a small number of selected investors, and for placing there is no need to be registered with the Securities and Exchange Commission, which means you don't have to list yourself with SEC. Okay, so on a private basis you can sell the shares to a certain number of investors. So for that you don't need SEC, neither you need prospectus. Okay. The second is public offer. Second is public offer. Now in case of public offer, this basically is an option where the company offers its shares to public at large, and this is done through stock exchange. For public offer, it's very important. It's a compulsory thing that you should be registered with stock exchange, and you can offer your shares to public at large. And because you are a listed company in this case, it is important that you need to have prospectus as well. Okay. So this is new equity issue. Now, it's time to move towards the question first, and let's look at the question, what it says. Let's start with a very important past paper question, section C. We all know the weightage is of 20 marks, which means you need to complete this in 36 minutes. Perform calculations that are carefully structured and clearly set out. Okay, and with all easy to follow the workings. For any theoretical answer, narrative ones, use simple English rather than long sentences. Okay, so let's begin with the question and let's see what is being asked in this question. A very good question, to be honest. Now the question that we are solving is a very important question, is a very good question, to be honest. And the way I will handle the question, you will see by yourself that the question will get easy for you and you will learn new techniques for sure. So do make sure that you are with me. It's a section C question. Without wasting time, let's read the requirements. The first part, the first requirement of that is calculate theoretical x right price for 2 marks. Second, assuming equity finance is used, calculate revised earning per share after business expansion. Third, assuming debt finance is used, calculate revised earning per share after business expansion. So there are two earning per share calculations that you need to perform, and this is after business expansion. So I'll cover up things very nicely today. Then it says calculate revised share price under both financing method after business expansion, 1 mark. And then at last it says use calculations to evaluate whether equity or debt finance should be used for planned business expansion. Now this is also a very good requirement. Evaluation is a verb. Then it says discuss 2 Islamic finance sources which companies should consider as alternative to right issue or a loan note issue for 6 marks. So I think it's a very good question and it will test the students' knowledge very, very thoroughly. And the way we're going to solve this, I'm sure you will be in a very good position after understanding the working style, and it will become easy for you to handle in the examination for sure. Okay. So let's begin without wasting time. Let's solve using a spreadsheet. So let's open this spreadsheet first. So let's begin with the solution. Now, it's a very good question and I will exactly teach you how to handle. Let's read the scenario. Tin company is planning an expansion of its business operations. Now listen, according to my experience, and note down my words, these are golden words to be honest. According to my experience, what I've seen the trend in ACCA FM paper, your examiner, whenever sets up a question like this, your examiner will use 2 things as a basis for raising the finance. Either in your ACCA exam, the reason 1 to raise finance would be about business expansion, okay, as this is the case right now, which means that business will expand its operations, so that is why they are raising the finance. And second reason for raising the finance will be repayment of existing loan. Repayment of existing loan. So the reason 1 will be business expansion. The reason 2 will be repayment of existing loan. Getting the point? So these 2 will be the reason normally, because of which they will raise the new finance. So right now if you see here, it is very clearly mentioned that its plan is to expand the business, which will increase their profit before interest in tax by 20%. This is a very key thing to keep in your mind. The company is considering whether to use equity, this is 1 source of finance, debt, this is 2nd source of finance, to raise 2 million, this is the amount of finance needed by the business expansion. So this is my experience, and you look at the past paper history, you will realize by yourself that there are 2 major reasons which are tested in your paper, and these are the 2 reasons for raising the finance. Number 1 is to go for the business expansion or to repay the existing loan by raising the new finance. So the options that are mentioned here are equity and debt finance. So let's evaluate. If equity finance is used, 1 for 5 right issue will be offered to the exiting shareholder at $20 discount to the current share price. In paper of FM, numbers, percentages, it is really important to highlight those in your paper. Okay. To current ex-dividend price of 5, the nominal value of ordinary share is 1. If debt finance is used, tin company will issue 20,000 8% loan notes with a nominal value of 100 per loan note. So option 1 is of equity, option 2 is of debt, and Both the options are very clearly mentioned, and the purpose of raising the finance is business expansion. So just note down what extra info I'm giving to you people, because I'm trying to cover many possibilities, different kind of questions that can come in your paper through this one question. So just note down, just listen to my instructions, my details. Financial statement information prior to. Now this word is very important for me and every one of you. Prior, which means this is the situation before raising the finance. So it's very important to analyze in a practical world, being a finance manager, that where we stand today and where we will be after we are done with the expansion or we have raised the finance. Because this is what we need to figure out, whether we'll be in a better position or we'll be in a worst position, right? So, profit before interest and tax, PBIT, current finance costs, taxation and profit after tax. Ordinary shares, retained earnings, long-term liabilities, total equity and long-term liability. The current price earning ratio is 12.5. Now today, if you are not good in business finance question like these, I'm sure inshallah you will be really perfect from today. Because the techniques that I'm going to tell you will help you. Just note down each and everything which I'm mentioning here on a piece of a paper. Okay? Because this is my favorite area, to be honest. Because the trick that examiner does here and the way I will counter those tricks, that is a big learning for you people. Corporation tax is payable at a rate of 22%. So there is a P ratio given to me of 12.5 times. This is the current P ratio. Companies undertaking the same business as TIN have an average debt to equity ratio. You know what is debt to equity ratio? It's debt divided by equity, okay? Book value of debt divided by book value of equity. We call this debt to equity ratio of 60.5% and an average interest cover of 9 times. 9 times. Now, this is given for the same business as TINCO. So, these are for the sector, right? Now, every information given has a purpose here. So, let's begin with the first requirement. Theoretical X right price. Now, one point to note here, which if you are not sure, so just note it down. It's a new information that I'm giving to you people. So, remember this very important thing that I'm telling you here. Now, one very important thing I want people to note down. If you don't know, if you haven't studied from me before in my regular online classes or anywhere physically, so listen, this is a golden thing I'm telling you. Theoretical X right price is a price that should be right after the right issue. So, this should be the price right after the right issue. This is top. Okay. But I'm telling you the exact time period that it represents. The exact time periods. So, top is a share price at a point where, just note it down, right issue has been done, okay, has been done. Once you do the right issue, when you give shares in the market, existing shareholder take up the right. This is the assumption behind it. 100% shareholder will take up the right. And you have the funds in your hand. So this is point where right issue has been done and funds raised. Funds have been raised. The funds are with the company. Right issue is, top is that point where company has the funds in their hands, but not invested yet. or a better word here would be use, because I don't know whether they will invest it or they will repay it, okay? So, but not used yet. So, anybody who's not aware of this fact, just note it down. TERP is that point of time where the right issue has been done, funds has been raised, but the funds are in the hand of the company and they haven't used the funds either for expansion or for the repayment of debt, whatever the case is. You know why I'm mentioning this separately? Because I'll prove you later on in this question why knowing this fact is important for you people. Anyways, let's work out the term. So, there are two methods to work out term, but I'll use the one that is the most easiest one, which is mostly used in the paper. And that is the method I'll use here, which is known as per right share method. Per right share method. Now, what is the method? So, I'll just go up and we'll look at the information, we'll highlight the information. It says 1 for 5, the current share price is 5 and 20% is the discount. So, for every 5 ordinary shares, you will be granted with 1 right share. For every 5 ordinary shares, 1 right share. And that too at 20% discount. So, let me work out the value of the share price after discount. It's 5 multiplied by 0.8 if I do it 0.8. So, this will be 4 if I'm not wrong, right? This will be 4. So, the value that we are getting is 4 and this is the value of right share. Actually, we will issue the right share for $4. So, this is 20% discount what I was mentioning, what is written in the question, okay? So, this is the 20% discount point. Anyways, so considering this, what's the key to keep in your mind? The key thing to keep in your mind here is that how to work out this. I'll just go to the spreadsheet. I'll write here part A. First requirement, work out TERP, and the formula is a very easy formula which you can perform in one cell as well, or if you want to make it simple, so you can use 2 to 3 cells then, okay? So, as you can see here, open 2 brackets, 5 multiplied by 5 share price, bracket close, right, plus another bracket you will open, 1 into 4, close the bracket. Now, I want this numerator together, right? So, this is your numerator working that you have done and you will divide this with 6, okay? You will divide this with 6, that is your denominator, and you will be getting the answer of 4.83333. So, sometimes right using of brackets is important, otherwise you can get an incorrect answer. Anyway, so this is 4.833, right issue TERP, that price, share price right after the right issue, but before the use of funds, company hasn't used the funds yet. Done. Now, let's move on to the next requirement and let's see what it says. It says, assuming equity finance is used, which is actually right issue, calculate revised earning per share after business finance. Sorry, business expansion, 4 marks. Now, listen very carefully what I'm doing here. It's interesting. Requirement 2. Earning per share is what I need to work out after business expansion, okay, using right issue. This is what the requirement is. And very much similar thing can come in your paper as well. So how to deal with this? How to handle this in the paper? Try to understand how to handle this in the paper. That's important. That's crucial. How to handle this in the exam is very simple, and I'll make this simple. So try to figure out what exactly I'm doing. I will use less working to get the answer. Can you tell me what is the formula of EPS? So I'll write here for you people. The formula of EPS is profit after tax divided by shares. The first thing that you should know is the formula of that respective ratio that you will work out. So it's PAT divided by shares. Getting the point? Okay. Now, as you are required to work out the share price after expansion, so how to approach this? So very simple methodology I'm telling you here. What information you have in the question? See, you have PAT here. Yeah, you have profit after tax of 1,000 and you have current shares as well. So the nominal value is 1 as it is mentioned in the question here, right? So you have 2,500 number of shares in front of you. Okay? Clear? So the information that you have is of number of shares as well as profit after tax. Now, what can you do to work out this with least calculation? Is that you write the profit and you write the shares. Right? You write the profit and you write the shares. Just try to understand what I'm doing here. Write the profit and write the shares. And just imagine, just think that if you raise finance through right issue, okay, and you invest that for business expansion, because of this, will your numerator change and will your denominator change? Just think like this. Will your numerator change? Will your denominator change? You need to give a quick answer about this. In the chat box, I'm asking you people, I want this to be interactive. So what do you think? Just write yes or no's. What do you think? Because of right issue, will number of shares, the denominator, change or not? So the answers that I'm getting here, let me see, says yes. The denominator, it's a mixed answer actually. Denominator will change or not? The answer is, few are saying yes, few are saying no. Now this is what I want you to learn here. The denominator number of shares will change. Why? Because of the right issue. Right issue will change the number of shares. Obviously, right? Because you're issuing new shares. So the shares will change. So what to do? Let's figure out. Let's figure out the new shares. Okay. How many new shares will be issued because of the right issue? Is it difficult to find out? No, it is not. You go to the question and see in the question, how much finance do we need to raise? So, sir, we need to raise 2 million. Okay, 2 million. Fine. Our calculations that we are doing are in thousands right now, right? So, let's keep this in thousands. So, you need to raise 2 million. And How much is the issue price of the right share? It's 20% discount to the normal price of 5, right? Which means we will be issuing this for $4. Yeah. So 2000 is what I need to raise, and each share that we'll issue will be for $4, which means how many new shares you will issue. So new shares in form of right issue will be 500 shares. How many? 500 shares. I'm sure you will agree with me on this point. It's not at all difficult, to be honest. So because of this right issue, your shares will change and will go to will increase by 500. These are your 500 right shares that you will issue, because you need to raise 2 million and each right issue will be issued at $4. So like this, you need to issue 500 right shares to gather the amount of 2 million or 2000. Agree? Okay, agreed. So you know the denominator will change by 500, which means 500 shares will be added to the denominator. I'm sure there is no question as far as this is concerned. So denominator will increase. Ask yourself, yes, it will. By how much amount? By 500. Simple. Okay. What about numerator? Come on, quickly answer. Do you think numerator profit after tax will change due to this expansion that you will do? Obviously, the answer is yes, because the question has stated that there will be a 20% increase in the profit before interest and tax, but make sure it says profit before interest and tax. This is crucial, okay? So 20% increase in your profit before interest and tax, and this is 1597 right now. Okay, this is 1597 right now. So it's very simple. Look here what I'm doing. $1597, 20% of this amount. So let's work out 20% of this amount. Okay, so 20% of this amount is how much? So let's do a quick math. 1597 multiplied by 20% is 319.4, which means your profit before interest and tax will increase by 319.4 because of the expansion. Do you agree with me on this point? You should. Okay, great. Now, this is the amount by which the PBIT will increase, and this is obviously before tax, before interest. So, there will be no additional interest cost because of the right issue, obviously. Because if you go for the right issue and you expand the business, there is no additional interest cost. Okay, this is a fact, right? No additional interest cost because you're going for the right issue. So let's just make this after tax. So how much is the tax rate in the question? Do we have tax rate? Yeah, we have 22% tax rate. So if I multiply this with 0.78, okay, 0.78, so I will get the figure profit after tax. Please just listen to me very carefully. Profit after tax. So it's 319 multiplied by 0.78 and it's 249. Let's round it off. 249.132. Okay, fine. 132. Now this amount of 249.132 is the amount by which your profit after tax will increase because of this expansion done through right issue. Simple. So my technique is to work out the additional changes in your numerator, in your denominator, and that's it. So in your current figures, just incorporate the changes, whether those needs to be added, so add them or deduct them, and you will get the revised figures. So the profit is 249. Okay, so the new profit after tax will be 249. Okay, will be 249. I hope you will agree with me on this point. Right? So that's it. Done? Done. Let's work out EPS. Very simple. Revised EPS. So see what I'm doing. Profit, current is 1000. Add the new profit after tax of 249. Can you see here? Okay. So this is 1249 and shares 2500 the current shares plus the new shares 500. Okay. So what is the formula of EPS? You can work out now. 1249 divided by 3000 shares will give you answer of 0.416. Easiest way. Just work out the differential figures, the additional or the incremental figures. So what is this technique? Let's sum up. When a question like this requires you to work out anything, just remember the formula of the current, just remember the formula, EPS, PB, profit after tax divided by share. And just write the current figures that are available from profit and loss statement or balance sheet. And in those figures, just include the additional incremental amounts. Just ask yourself, any change in numerator or denominator, just work out the changes, just incorporate it, that's it, done. Agreed? So I hope you understood my technique here. What's your feedback? Easy or difficult? Ibrahim, interest additional will not come in case of right issues. It will not come in case of right issue because right issue doesn't give rise to any additional interest cost. The current interest cost was already part of the current profit after tax. Okay? So, you like the approach? Yes or no? Yeah, existing interest in existing profit after tax. You like the approach? What's your feedback? Say yes or no. Is it easy? Okay. Now, you try to apply the same approach on the next part. So, let's see. Now, the second requirement. Okay, what is the second requirement? Third requirement, in fact. So, the third requirement is, it says, calculate the revised earning per share assuming debt finance is used. Now, again quickly, very quickly, let's be more faster here. EPS, the formula is PAT divided by shares. Let's think here. What is the current PAT? It's 1000. What are the current shares? 2500. Now, let's quickly think. Because of debt finance option, do you think there will be a change in the shares? Let me see how many will answer me quickly. Any change in number of shares? Yes or no? Any change in number of shares? No. As it is, same. Okay. So, if you are saying no, which is the right answer? So, revised shares, same. Great. See, you don't have to do the additional effort now. You know, no change in shares. Okay. Any change in profit after tax? The answer is yes. The change will be in profit after tax, and this will be due to How many reasons? So this will be due to two reasons. Listen, just work on incremental figures. The current is as it is there. Just work on incremental figures. So let's go back to the question where I will easily figure out. I've already worked out one thing, and that is I know the profit will increase by 319.4. Okay, the profit will increase by 319.4. Getting the point? I'm sure it's simple. Okay, so the profit will increase by increase in PBIT will be 319.4. If you want me to do the working, I can do the working as well for you people here. It's not a big deal. So the working will be 1957 into 20%. 1597 into 0.2. Okay, so this is PBIT. Now, will this increase your interest? Yeah, it will, because you are going for debt finance option, and debt finance means that your interest will increase. So you will issue 20,000 8% loan notes with a nominal value 100 per loan note. So yes, 8% is the coupon rate, right? So this 8% coupon rate will be applied to the 22 million amount that you will raise. So this is the additional interest that you will pay because of the debt finance option that you're going for. So how much will be your additional interest? So it's simple, increase in interest is equals to 2,000 into 0.08, that's 160. Okay, that's 160. So let's make this negative here because I will deduct this obviously. So that's 160. This is the additional interest on this new amount of loan. So if I just work out the net off figure, so this is the figure of 159.4, and remember, don't forget to make this after tax. So let's multiply this. So this will be profit after tax, and let's multiply this with 0.78. So once I multiply with this 0.78, because I need to make this after tax, and this will be 124.3. 124.3. So I'm sure you are understanding what I'm trying to achieve here is I am focusing on only incremental things. I will quickly repeat. The profit will increase by 319.4. Interest will increase due to the new loan that you will take. The coupon is 8% applied to 2 million. This is the figure before tax. This is the figure after tax. So let's work out the revised one. So it's simple. 1,000 plus the revised, the increase in profit, and it's your revised figure. Let's work out the EPS. 0.44. So you guys, I'm sure, will understand what I'm doing here. Why are we not adjusting the tax figure? I've already done that. By multiplying this with 0.78 means I am incorporating the tax impact. Okay. So see, this is the answer I'm getting here. 2 EPS having a weightage of 4 marks each. What is the strategy? Just recall the formula, then input the current figures, and then ask yourself any change in numerator or the denominator, and if you say yes, just incorporate that additional change into the current figure and you will get the revised answers. Simple. So guys, a quick feedback. Understood? 2 answers of EPS. Understood? Is my strategy clear to all of you? Is it easy to grip? Understood it? The way I dealt with this issue was pretty much simple to the point. What do you think? Yes or no? Okay, great. Thank you for a wonderful feedback. Now, done with this part, this part. Now is a very interesting part, even though the marks are pretty less, but it's interesting. Sir, interest should be after tax. Yeah. The impact of that automatically will go into the profit, you know. Why? Because once you deduct interest from profit, so you get a profit after interest. And then when you apply the tax rate, so the impact of that already goes into the profit of that interest tax impact. Okay? Arit says, in this question it mentions PBIT has been increased by 20%, but what if it doesn't mention what will be the impact on numerator? It's a very good question from Arit actually. If the question is silent in terms of the profit increase, so you will consider that the current figure will remain same in that case. Okay, Arit? Until and unless the change comes because of interest. As far as the PBIT increase is concerned, so we'll assume the PBIT will remain same until unless it is not mentioned. Okay. Now, this is for 1 mark. And just understand, if you have taken my previous webinars of the last day especially, so you will understand what the issue here can be. It says calculate revised share prices under both financing methods after the expansion. Now, share price calculation is dealt by which area? VAC? Did VAC taught you how to work out share price? I expect answer in the chat box. Or business valuation taught you how to work out share price? Business valuation. See, this is how my students can clarify the issue in their minds, the confusions. Yeah, it's business valuation. If any question requires you to work out the share price, it's none than the other business valuation that will resolve your issue. So it's a business valuation part, indirectly if you see. Now, if it is business valuation, the question that next come into our mind is, there will be valuation techniques that need to use. So the valuation technique that I covered in my previous day was cash based, which included discounted cash flows and DGM. The second group was asset based. The third group was income based, which included price earning ratio method of valuation, earning yield method of valuation, and dividend yield method of valuation. Now the question that comes in my mind, that which valuation technique will I use in this case, because I need to work out the share price. Students get confused in the paper. So don't worry. Rizwan Maniya is with you. Which valuation technique to use? Now I'm asking you people. What will be your replies? So, the method to use is very clearly not given directly, but a very clear indication is given, and learn to know the indication. And the indication is you are given with a PE ratio. You are given with a PE ratio of the thin company, okay? The current PE ratio of 10 company, current PE ratio of 10 company is 12.5. Now, this PE ratio is giving you a signal that you have to use PE ratio method of valuation. This is the biggest indication that you have to use PE ratio method of valuation. Biggest indication. And this is how your examiner usually indicates. So the first thing is clear, PE ratio method. But the problem still exists, and a very conceptual student will ask certain questions again. The share price that I need to work out is after expansion, okay? So let's do one thing. Let's go to this requirement 4. I need to work out share. I need to work out share price and remember share price after business expansion, okay, not the current one. Okay, business expansion using both the methods. One is the equity, that was right issue, and second is debt. Okay, now first of all, what is the formula of P ratio method? How we work out share price? We work out share price by using a formula. Share price is equals to PE ratio into EPS. This is the formula that we use. Okay? Share price is equals to PE ratio multiplied by EPS. Now the concerning thing here that is irritating me right now is I want the share price after expansion, which a conceptual student will understand. Okay, if you need to work out share price after expansion, so both the components that are given in the question, that is the PE ratio and the EPS, both should be after the business expansion. That's a common sense. This should be after business expansion and this should be after business expansion. I'm not teaching you here just to quickly finish my job. I'm teaching you here conceptually, so that still you have chance to make your concepts correct before you attempt the FM paper for March 21. Even if you're not my student, so I want you to make sure your concepts gets right. So this should be after expansion. Both should be after expansion, to be honest. Okay. So we have EPS after expansion 1. We just worked out here. And for right issue, it was 0.16. Let me give you the reference. Yeah. So one problem has been solved. I have EPS of after expansion for both right issue and debt that I've done the workings before. That's not an issue. But I need PE ratio that should be after expansion. So from where to find that? If I went back to the question, I have a PE ratio, okay, that's a good thing. But this PE ratio that I have is basically current price earning ratio. Current means right now. Right now means before the raising of finance and the expansion. Current means what? Current, as of now. Before the raising of finance and expansion. I'm sure you will agree with me on this point. So now what to do? It's a serious problem. Come on. Can you tell me what to do? What to do? This P ratio is the current P ratio, and technically if you need share price after expansion, so every component should be after expansion. So what to do? Please, I'm not getting your answers. This means you are confused. What can we do in this case? What option do we have in this case? No. No. Come on, can you tell me the answer? So I will take an assumption here. And the assumption is, I will assume, now this is important to understand conceptually. I'll assume that whatever P ratio is right now will be the same after the expansion, which practically is not possible. In a practical world, that is not possible. But theoretically, yes. So it's the assumption that we'll take that the current P ratio will remain same after the expansion as well. So we will take 12.5, and this is just an assumption that I took here. So make sure you are very much clear as far as the concepts are concerned, and you should know conceptually what you are doing. So this is what I wanted to explain you here, and I'm getting two share prices here after the expansion. So I hope I've made this very simple, clear, systematic. And one thing was important. I know the marks were just one, but concept was there. Okay. So we'll assume whatever P ratio is right now will be the same. And this is an assumption very much common in the paper. Understood? Okay, great. So, are you understanding the way I'm explaining you all these things? Come on, what's your feedback? Happy? Okay, great. Now, let's move on. Done. Then comes another 4-mark requirement. Using calculations that you have done above, evaluate. What is evaluate? You know what this verb means? Judge. Evaluation means judge. Evaluate whether equity finance or debt finance should be used for the planned business expansion. So normally when you are required to evaluate, you look at the positive aspects, you look at the negative aspects. And you have to evaluate what? You have to evaluate whether equity or debt finance. So this is your object. I'm sure you know what object is now because I covered in the previous day. So now you have to make a judgment. Is equity better than debt for this expansion? 4 marks. Now what to do for 4 marks? What are the things to consider for these 4 marks? So listen, examiner gave you one thing here, and this is what I've highlighted in front of you. This information is what is given to you that you'll use for this 4th part. You are given with the sector debt to equity ratio by book value and interest cover of sector. So now what you can do is, you can also work out these for both equity and debt, and on the basis of this analysis, you can then give your evaluation. Because this is a hint given by the examiner. If examiner has mentioned something of sector, which means you have to use that. So, first of all, let's do a quick thing for this requirement. Let's do a quick thing. Requirement 5 is that let's work out the current gearing, okay, and current interest cover. If you will not do this, you will lose marks, remember, Okay. So current gearing, debt divided by equity by book value, because the sector is also the same. So let's use the formula. What is the current figure of debt given in the balance sheet? So the current figure of debt given in the balance sheet is 4,500. Okay. And what is the value of equity given the balance sheet? It's 2,500 and 5,488 book value. This is book value, right? So book value is clear. So let's use the numbers. 4,500 divided by 7,988, and the answer you are getting, let's convert this into percentage to one decimal. No, just round it off. 56% is the current gearing. Okay. Interest cover. Let's work out the interest cover. So the current PBIT is 1597 and current finance cost is 315. Okay. So it's 1597 divided by 315 and it's 5.06 is your interest cover. Okay. Because the sector average was given, so we had to use this for our evaluation purpose. Now this is the current. Now let's work out these two. Keeping in mind equity finance, and then let's work out these two keeping in mind debt finance, and by this we can easily conclude then. So let's do the workings quickly. What change will come? This is the formula I have in front of me. What change will come? So let's incorporate the changes, friends. See, the same approach I'll adopt here. I'll just change the current figures. We'll incorporate the additional things into this. Now, in case of equity finance, obviously, it's very simple. The equity, the debt remains the same, okay? And equity 7,988 will increase by the amount of 2,000. You know why 2,000? Because this is the amount by which you will raise the finance. So 2,000 is the equity that will increase because of the new finance of right issue. The rest remains the same. Debt remains the same. Previous equity plus 2,000 additional one. Getting the point? So this is the answer. Sorry, I need to use the bracket here. Yeah. Sometimes not using right brackets results in wrong answer. So it's 45%. Very easy. So quick. Now interest cover. What change? Your PBIT will definitely be affected by this. Okay, PBIT will be affected by this. So we know the amount by which our PBIT will increase. Yes or no? Yes, we know that. We have worked out that amount as well. That amount is given here. It's, see, let me highlight this for you people. This is the amount of PBIT, right? 319.4. This is the amount by which PBIT will increase in case of right issue. So let's incorporate this into the current figure. Okay. Open the bracket. Make sure you open the bracket. Plus 319.4. Close the bracket. So your PBIT will increase by this amount. Divide by the same finance cost. And the answer is 6.1. Done. Now, in case of debt, what will happen, friends? Your debt will increase by 2,000. Okay? Your debt will increase by 2,000. Open the bracket. Add 2,000. Close the bracket. That's it. Any change in equity in this case? I don't think so. Any change in equity? There will be no change in equity in this case, right? So we have this revised figure of 81 quickly, and the last is interest cover. So open the bracket, Now, PBIT will change by 319.4 as I showed you earlier, whereas the finance cost will also change. So, the finance cost currently is 315 plus 160 of the new loan. Interest of the new loan is 160. I know you can recall the figure that I just used that above. So, yeah, this is the new figure and this goes to 4.03. Okay, 4.03. So, this is the answer. I'm sure this is clear to all of you. The workings that I have performed in front of you, the changes that I've did here, and you have these figures. Now, based on all these things and the share price, obviously, let's conclude. Let's think what to write. See, so I have two share prices here as well. Okay, let me just write the share prices as well so I can have a good consideration of that. First of all, let's do a quick analysis. If I go for equity, so if I go for equity, my gearing goes down. Okay, gearing goes down and interest cover improves from current. Gearing goes down, interest cover improves. Now, what do you think? Is this good for the shareholder? Come on, give me answers. Yes or no? Is it good for the shareholder? So, good for shareholders. Okay, good for shareholders, right? Fine. Now, you compare current with the option of debt. Wow. Gearing increases badly from 56 to 81. From 56 to 81. And cover also reduces from 5.6 to 4.3. So, both the things are bad. So, not good for shareholder. Now, see what twist will come here. Not good for shareholder. So, keeping in mind the current gearing and interest cover, equity seems to be a better option and debt doesn't seem to be a better option. You can even relate this with the industry average. 60.5 times and 9 times. So, 60.5 times percent, and 9 times. Now, do keep this in your mind as well. The current gearing position of the company is, in terms of gearing, the company is less geared than the industry. Whereas in case of interest cover, the company's interest cover is less than the industry. But the point is, when you go towards debt option, both of these are more bad than the industry. That's the point. More bad than the industry. So you have to use the sector as well. Which means right now, equity seems to be a viable option than the debt one. Because in case of equity, you will be in a better position compared to the current situation and then industry, especially when I say gearing. But for the final, we also have to consider share prices. See share prices here. Now, share prices. So what do you think about share price? In case of equity, the share price after expansion will be 5.2. And in case of debt, the share price after expansion will be 5.6. Are you all getting my point? So now, come on, one important question. Now, by looking at the share prices, what will be the situation? So, let's compare this share price with the current share price. And listen here, the concept will be tested. In case of equity, I'll compare the revised share price with what? Come on, tell me. Should I compare this with the current share price or should I compare this with top? Come on. Current share price or top? Current share price is 5. Should I compare this with top or current share price? So I'm getting maximum answers here in support of top. Exactly. You're good. You're good in terms of concept. Top. So we have to compare in case of right issue with top. Remember, in case of right issue with top. So if I compare with top, it's 4.83 if I'm not wrong, right? 4.83. Yeah. So if I compare with top, in case of right issue, so how much increase the shareholder will enjoy? 0.37. Their share price will increase by 0.37. Okay. And now in case of debt, come on. Now in case of debt, tell me. In case of debt, I don't have any top. Right? In case of debt, you don't have any top. So in case of debt, you will compare this with what? Can you tell me? You will compare this with what? You will compare this with, yes please, the current share price of 5 because there is no top in case of debt. So that's 5. So, wow. What happens? Now, see, it's strange. Listen, do consider all these in your mind and listen to me very carefully. Let me highlight this for you people. Equity seems to be a better option considering gearing and interest cover. Okay? But the capital gain investor is getting by the amount of 0.37. Right? On the other hand, debt is not a good option considering gearing and interest cover. But in case of debt, the capital gain is by 0.6 more than equity. See? Come on. Are you able to conclude what I'm trying to explain to you here? I'm taking my time because what's the use if you don't understand the concepts through this webinar? It's useless then. Are you getting the point? So it's a situation, a mixed situation. Because gearing and cover says go for equity. But the capital gain says goes for debt. Go for debt. Because in case of debt, your capital gain will be more than equity. That is by 0.6 and in equity it's 0.37. So now, what do you think? What should be the advice? Considering a balance, a win-win situation for shareholders, a win-win situation. What do you think? Win-win situation for the shareholder. So for shareholder, a win-win situation will be go for equity. A balance needs to be considered. This is evaluation, positives and negatives. We are looking at positives and negatives, right? Evaluation, positives and negatives. So a balanced situation would call for equity. You know why? Because they are getting a capital appreciation, number one. Secondly, their financial risk is also very under control because shareholders are also concerned about the financial risk of the company. So the financial risk is also very much under control and they are also getting a capital appreciation. So considering a balance, equity seems to be a better option because they are getting the capital appreciation as well as their financial risk of the company is under control because shareholders are concerned about the financial risk as well. Getting the point? So equity seems to be a better option. So my point here was evaluation required you to consider positive and negatives and that you did consider. Here, in case of equity, you just saw this was a positive thing about equity and this was a negative thing about debt. But here, this was a negative thing about equity, but this was a positive thing about debt. See? So the final seems to be equity because it is a win-win situation, giving the appreciation as well as controlling the financial risk of the company. This was for 4 marks, and I'm sure you are getting exactly what I'm trying to explain you here. So they are done with this part. Let's move on towards the next one, the last one. Discuss examinable verb, 2 Islamic sources of finance. 2 Islamic sources of finance which company could use as an alternative to right issue or a loan note issue. Any 2 that are alternatives of right issue or loan note issue. This is for 6 marks. So it's very simple breakup, as 2 are required. So 6 divided by 2 makes 3 marks each. Makes 3 marks each. Now, which 2 are used as an alternative of right issue? Right issue is equity, okay? So you have to tell an alternative of equity or an alternative of debt, okay? Loan is debt. So which 2 sources of finance? Let's go to our handout and let's see. Now the first one that is an alternative of equity is basically Mudarba, partnership. Mudarba, partnership is an alternative of equity. Okay? So Mudarba is an alternative of equity because in Mudarba, one party brings the investment known as Rabbul Mal, and the other party known as Mudarib works there. So one is a working partner, one is a sleeping partner. I'll not go for Musharika because Musharika requires both the parties to contribute. Both the parties to contribute, like a joint venture. So similar to this is more Mudarba, where one party brings the finance equity and other is the working one. Share of profits are decided equally between both the parties. This is what you have to write for 3 marks in a paragraph form. These are bullets. These are easy to learn bullets through my easy notes, okay? But you have to write this in a paragraph form. So share of profits are decided at the beginning, whereas Rabbul Mal, the investor, will bear the loss only, okay, the financial loss, and Mudarib, the working partner, loses his time and effort. So Mudarba, you have to write in a paragraph form. These points will be written in a paragraph form. Contract can be terminated anytime by a prior notice. So Mudarba for 3 marks. Now the alternative of debt is none than the other, Sukuk. Sukuk, alternative of debt. Okay? So according to Islamic finance, they don't give you debt. They don't give you loans. So you will get a share in the tangible asset of a company. Now, you get a share, which means you are the owner of that tangible asset of a company. And because you are the owner, because you are subject to risk and rewards, you get the share of revenues as well. Okay? Now, for Sukuk, because Sukuk give Sukuk holder the right of risk, right of ownership. So this means that Sukuk holder will get the share of revenues, and Sukuk holder is the owner of the asset, because Islamic Bank will never give you loan. They become owner of the asset of an organization. So Sukuk are tradable as well as your normal debts are tradable, bonds. So Sukuk are tradable as well, and so Sukuk holders can sell these to other person or bank. And remember, the rights and the obligations are of the Sukuk holder. So this is an alternative of debt, Sukuk, and alternative of equity is Mudarba. For 3 marks, you have to write these points in form of paragraphs. I hope this is useful for you people. So we are done with this very important question. of exam, which was for complete 20 marks, and this question definitely is a one that is useful, to be honest, right? And question like these are expected in the paper, so I hope you will understand and learn the techniques. So let's move on. Now, coming towards risk management, a quick overview, the types of risk in risk management. The first is transaction risk. This is a risk because of which exchange loss arises. Transaction risk is basically a risk when you enter into a contract and you make the payment for that. For example, you want to pay ACCA exam fee, okay? And today the rate is Today the rate is 195 rupees, Pakistani rupees per pound. Okay. So now you will pay the fee after 10 days. So after 10 days, there is a chance that the rate will go to 200 per pound. Okay. So if rate goes up, you will incur an exchange loss. So transaction risk basically is a risk because of the time delay between entering into the contract and settling it. It's a cash-based risk. For example, you bought a equipment from USA and today the rate of $1 is 160 rupees per dollar today. You entered into the contract today and you took credit for 1 month. So you will settle in 1 month's time. So now you expect that the Pakistani rate will go down, it will devalue the currency, and the rate in 1 month's time when you will settle it will be 170 per dollar. Okay? So you can clearly see here that there is an expectation that the rate will increase from 160 to 170. So this will result in an exchange loss. Transaction risk, the word risk is giving you the idea that is the chance of loss due to the movement in exchange rate. So you entered into the contract today, but you will settle the amount 1 month later. So by the time you settle, there is a chance that dollar will increase by 10 rupees. $1 will increase by 10 rupees. So this is the additional amount that you will pay then. So this is the transaction risk. So we want to secure ourselves, we want to protect ourselves against the rising rates, and if it will affect us badly, adversely, so we want to protect ourselves, and that is why we go for different hedging techniques, the techniques that will hedge you against transaction risk. The famous techniques that are used for hedging transaction risk is number 1, forward contracts and money market hedging. Okay, so these are the famous techniques to hedge transaction risk. Now, economic risk is basically the long-term version of transaction risk, which means that you actually do a business of import. So you buy products from outside the country and you sell in the local market. So every time you buy something, the exchange rate adversely moves and you incur exchange loss. So as you are doing the procurement on a regular basis, so in long term, it says long term version of transaction is, on every transaction you incur exchange loss, that is the exchange loss that you are incurring. It is expected that you will incur loss in every transaction. It's a transaction risk, transaction wise. Okay. But the longer term impact of that exchange loss will be that in long run, your cost of products will be increase and you will increase the selling price and your market will go down because people will not prefer buying from you. People will not prefer buying from you because your cost will increase. And if your cost increases, people will not prefer buying from you. And you will lose business in the long run. So overall business will go down and that will result in the decrease in shareholder wealth. So it's the longer term version of transaction risk. Transaction risk is a risk of one transaction, but the risk of so many transactions means that it will have a big impact on your cash flows and on the shareholder wealth. Translation is an accounting risk. Every year, at the end of the year, when you translate your asset, liabilities, income, equities, expenses, so it's the accounting exchange gain and loss. So normally if you have an expected loss in terms of accounting numbers, that is a translation risk. It is very much applicable when one company has made investment into the other country. One company has made investment in other country. A parent company is in USA, made the investment in a subsidiary company in Pakistan. So at the end of the year, the USA parent company, because parent company has made investment in Pakistan, so for parent that is an investment in the parent's balance sheet. So at the end of the year, when that parent company will revalue its investment, so if due to exchange difference, the amount of that asset, the revalued amount of the asset goes down, so that is the translation risk. At the time of revaluation, you are expected to incur loss due to exchange rate adverse movement. So that is translation risk, but that is totally an accounting risk, accounting-based risk, book-based risk, not a cash-based risk. Okay. Now, the more important and the most important is transaction risk for your paper that you need to keep in your mind. There are 4 reasons why the exchange rate fluctuation happens. And when I say risk, so it is in my mind that I'm talking about the adverse movement of the exchange rate. That is why that is a risk for me. So there are 4 reasons. One is interest rate parity theory. Second is purchase power parity theory. Third is international Fisher effect. Fourth is expectancy theory. So 4 of these theories combine and make 4-way equivalence theory. So today my concern is with this and this. Let's move towards a question and we will see that how we will be discussing about these. So let's move towards a question, a very good question, and see what to do in that question. Now, please be with me. question of risk management and business valuation of section B are really trouble making questions for the students in the paper, because risk management will not come in section C. It will only come in A and B, and there are more chances that it will come in B. So, let's begin. Hurt company is based in country whose currency is dollar. Now, a quick tip. Whenever you are solving currency-based question, it's important to understand the home currency. So, dollar is the local currency here. As it says, is based in a country whose currency is the dollar. Okay? So, it's the local currency. So, dollar is the local currency. So, just note down, these are the $1 million techniques I'm telling you here. Then, the company expect to receive euro. So, if dollar is the local currency, so euro is the foreign currency. Okay? Expect to receive euro 1.5 million in 6 months' time. Now, in 6 months' time. So, what is the risk Herd company has? Herd company is facing a risk of adverse movement of exchange rate. Adverse movement of exchange rate from FindCo, a foreign customer. Okay. So, what do you think? For Herd company, they will receive 1.5 million euros. So, for Herd company, it's a receipt or a payment. So, it's a receipt. These are the things that I'm writing here are those that you should also find out in the question. The finance director of HerdCo is concerned that euro may depreciate against dollar. The value of euro will go down against dollar because they are expecting a receipt in 6 months' time. And if euro do depreciate, so they will incur a loss in the conversion of that receipt. Before the foreign customer makes the payment and she is looking to hedge the receipt. Protect yourself against this adverse movement. HerdCo has in issue loan notes with a total nominal value of 4 million, which can be redeemed in 10 years' time. Okay, now this is a separate paragraph. HerdCo has in issue loan notes with a nominal value of 4 million, which can be redeemed in 10 years' time. The interest paid on loan notes is at a variable rate linked to LIBOR, London Interbank Offered Rate. The finance director of HerdCo believes that interest rates may increase in the near future. Now, come on, what do you think if interest rates increases in the near future? So, having a long-term loan, do you think they are facing the risk of increase in interest rates? Yes. So, the first was currency risk and second is interest rate risk. See, both are tested here. First paragraph is currency risk and the second paragraph is interest rate risk, because they need to pay interest in the future, and if interest rate goes up, their cost of interest will go up. Okay. So, you will protect yourself not only against currency risk, but also against interest rate risk. The spot rate is the current rate, and you should know this thing. If you don't know, listen to me. You should know how to read the exchange rate. If you don't know this, you should know how to read the exchange rate. That's really crucial. That's really crucial. You should know how to read the exchange rate, because if you're not sure, in that case, you may end up in the wrong answers. You may end up with the wrong answers. Getting the point, everyone? So now, let's quickly discuss how to read the rate. How to read the rate. So it's basically what? It's euro per dollar. A quick idea I want to give so that if anybody is not aware, will get to know what exactly I'm explaining here. Now, listen to me very carefully. It's euro per dollar. Euro per dollar. Okay? So remember, if you are clear in a question what is the local currency, which you have already found out here, the local currency is what? Dollars. And if in the exchange rate you see dollars coming in the denominator, so it's denominator, right? It's euro per dollar. It means like this, euro per dollar. So dollar is in denominator. Okay? So dollar is your local currency? Say yes or no. Dollar is your local currency. So if dollar is your local currency and dollar is given in denominator, which means your local currency is in denominator. So when your local currency is in denominator, it is basically indirect quote. What is this? This is basically indirect quote. Okay? So how to determine quotes? It's simple. Indirect quote is what? When foreign currency is in numerator and local currency is in denominator, which is the case here. Dollar is in denominator, which is your local currency as it is clearly mentioned from here. So it's an indirect quote. And the vice versa of this is direct quote. Okay? So let's move on. The short-term interest rate is 2% per year, while foreign currency short-term interest rate is 5% per year. Okay. What is 6 months forward exchange rate predicted by interest rate parity theory? Okay, interest rate parity theory, 6 months. So let's go to the theory. Interest rate parity theory basically predicts the forward rates. It predicts the forward rates. There is a formula. Spot rate multiplied by 1 plus foreign currency interest rates divided by 1 plus local currency interest rates. And like this, we can predict the forward rate, right? So this was required to be done. Now, foreign currency and local is important to determine. Work out the answer. So what we'll do here is spot rate is 1.543 multiplied by 1 plus foreign currency. Foreign currency interest rate is 5%. Just prorated because it's a 6-month rate. So it's 2.5% divided by local currency. Prorate this, make it 1%. 6 months rate is what we need here. And like this, you will work out and get the answer C. Okay? Now, it's all theory. See, this is the troublemaking aspect of this paper. When it comes to risk management and business valuation, these are the areas where students are badly struggling. Theory is really creating confusions. So let's deal with the theory. As regard the euro receipt that they'll receive, what is the primary nature of risk faced by the HERDCO? Is it transaction, economic, translation, business risk? Now, you can answer me very quickly, please. So, they expect to receive this amount in 6 months' time. So this means they have entered into the contract today and they will receive the amount in 6 months' time. 6 months' time. They have entered in the contract today and they will receive the amount in 6 months' time, which means entering into the contract and settling it. The difference between these two is transaction risk. Transaction risk. Okay? Transaction risk. Great. Clear? Now, which of the following hedging methods will not is important, be suitable for hedging the euro receipt? Will not, because they want to protect themselves, as it was clearly mentioned. So, which is not a suitable method for them? Okay. Forward contract is a suitable method. You lock yourself into a forward contract. It's a suitable one. Money market hedging is a suitable one. Okay. Currency future. Derivative currency future. This is a suitable one, where you can buy the futures and sell it later. Currency swap is not the right option because currency swap is normally used for long-term contracts. 5 years, 10 years. So you should know the theory of swaps, futures, options, because these three will not be tested for calculation. Currency swaps, currency futures, currency options will not be tested for calculation. So you should have a very good grip over the theory. Forward contract, money market hedging will come for calculations. So swap is for long term, and this is not a long term. It's a one-off hedging that they are doing. One-off hedging they are doing. They expect to receive an amount, so that's it. So it's not a long-term 5-10 years contract dealing with the particular party. So swap is not a good option. The rest are. Simple. So theory should be in your mind. You should know the main thing about swap, futures and options. What I'll do, I'll share in the WhatsApp group a good summary of these. You just noted down the theoretical points of these and this will really help you. So be part of the group. 19. Which of the following support finance directors' belief that euro will depreciate against dollar? Now, as you just look in the scenario, it's scenario based. As you can see in the scenario, the finance director believes that interest rate may rise in the future. Okay. Second, the finance director is concerned that euro may depreciate against dollar. Euro will depreciate against dollar. So now the question is asking you, if director thinks that euro will depreciate against dollar, which statement is supporting this belief? What a question, what a question, what a way to test theory. Now let's read it first. The dollar inflation rate is greater than the euro inflation rate. First of all, let's quickly check this. Okay. Now, if I go to the upward information, I don't see any rate of inflation here. We have interest but not inflation, so I can't check this. So one method of checking gone. So how will you decide? Concept. And that concept is purchase power parity theory. Like interest rate parity theory, so interest rate parity theory is basically relationship of interest rates with the exchange rates. Same purchase power parity theory predicts the future exchange rate, and how this is done. 1 plus foreign currency inflation divided by 1 plus foreign currency local currency inflation rate. Okay. So, purchase power parity theory considers the relationship of inflation with currency. Now, it says higher inflation rate subjects to higher depreciation of currency. Now, the country where inflation rate is higher will be subject to higher depreciation of the currency. Now, considering the director's view, who thinks that euro will depreciate, means that according to purchase power parity theory, if euro depreciates, so the inflation rate of euro should be higher according to this theory, because it says higher inflation rate subject to higher depreciation of currency. So, according to the belief of the director, if euro is to be depreciated, so the inflation rate of euro should be higher compared to the inflation rate of dollars. If this belief is correct, so the euro inflation rate should be higher than the dollar's inflation. Try to understand this. So, is it the case? The statement says opposite to this. Statement says dollar inflation greater, which is wrong. If euro will depreciate, so according to purchase power parity theory, inflation rate of euro should be higher than dollars. So, dollar inflation rate should not be greater than euro. If this belief is a correct belief, so in reality, according to purchase power parity theory, the inflation rate of euro should be higher than the dollars, because any country which has a higher inflation rate, according to purchase power parity theory, is subject to higher depreciation of its currency. So, if euro will be depreciated or euro is expected to depreciate, so the inflation of euro should be higher than the dollars, which the first statement is against. It's the opposite, so that's wrong. Understood the way I'm explaining you here? Second, the dollar nominal interest rate is less than the euro nominal interest rate. Now, can I check this from the question? Let's go first of all. Dollar, remember, dollar interest rate is less. So, see, the domestic dollar interest rate is 2, whereas the foreign euro interest rate is 5. So, this is true first of all. As far as the information given in the scenario is concerned, it's true that in the current question, the dollar interest rate is 2, which is less than the euro interest rate, which is 5. So, as per the details given, this is true. But is it in support of the director's belief? For that, I have to move towards interest rate parity theory. Spot rate into the differential of interest rates, okay? And you can predict the forward rate. Here is the forward rate. Now listen, for this belief to be correct, let's see. According to interest rate parity theory, interest rate, higher interest rate subject to higher depreciation of the forward rate. Now, in the question, the euro interest rate was how much? 5%. And the dollar interest rate was 2%. So, yeah, it's true. The euro interest rate is higher. And according to interest rate parity theory, if the interest rate of a country is higher than the other country, so euro interest rate is higher than the dollars, so that will be subject to higher depreciation of its currency. Higher depreciation of its currency. So, this statement is completely supporting the director's view. As director says that in future, see, this point is actually reflecting the director's concern, because the interest rate, that they can read this, the interest rate of dollars is less and the interest rate of euro is more. So if euro interest rate is more, so euro will be subject to higher depreciation of its currency, which is what the director says. Euro may depreciate against the dollar, and the reason, according to interest rate parity theory, is that the dollar interest rate is less and euro interest rate is more. So yes, this is clearly supporting the concern of the director, and you can see dollar interest rate is less than the euro. So as you just saw here, according to interest rate parity theory, country having higher interest rate is subject to higher depreciation of currency, which is completely a true thing. And yes, this statement is correct, which means answer B is correct. See how theory is being tested. Examiner is testing your knowledge of the theory here. And this is section B. So you have to keep in mind the scenario as well. Got it? Hope this is clear. As regard the interest rate risk, as I mentioned, that they are facing that as well, because interest rate will rise in the future. They have a loan. Which of the following statement is correct? Okay. In exchange for a premium, Herd could hedge its interest rate risk by buying interest rate options. Now again, understanding of derivative is tested here. Interest rate options. You have options, swaps, futures. These three are used for currency risk hedging, as well as these three are used for interest rate risk hedging. This is all covered in detail in the regular online classes that I've covered. Okay. So when you go and use the derivative of options, you pay a premium for that. Everybody should know this. You pay a premium for that, and that premium is non-refundable kind of a premium. Okay. So yes, if you feel like interest rate will increase in the future, you can buy interest rate options. An option allows you to exercise the option if there is a need, which means, for example, you can buy an option of 6%. The current interest rate is 5%, for example. Now, if the interest rate current goes to 8%, this is the risk you are facing. So you can use the option, you can exercise the option, and if you exercise the option, then you will not pay this 8%, you will pay this 6% as per the option. See, you are protecting yourself against the risk of increasing interest rates. So you will not pay that high 8%, you will pay 6%. Exercise the option. And even if you don't exercise the option, maybe the interest rate never went up because it was just a risk. It could be vice versa. But in any case, you have to pay the premium of the option. So this is a right option. This first is a right option because conceptually this makes a lot of sense. You pay the premium, you buy the option. If interest rate goes up, you exercise the option. Otherwise, you lapse it. That's okay. Let's read the other ones as well, just to get the idea. Buying a floor will give herd hedge against interest rate risk. Now listen, floor is the lower limit. It's the lower limit. It's not the higher limit. Cap is the higher limit. Okay. I do cover all these things in my regular classes, online classes. So cap is the upper limit, floor is the lower limit. Now, the risk is that interest rate will rise. So rising interest rate requires you to keep an upper limit or a lower limit. Obviously, upper limit. So cap is important for you, upper limit, so that you don't pay more than that. There should be an upper limit. The arrangement of cap and call floor is basically a collar arrangement. It's a collar arrangement. Okay. It's a collar arrangement. But right now it's completely clear that's not right, because floor is a lower limit thing, and you need something that is of upper limit cap, because you don't want to pay more than that as interest rates are rising. Okay. So that's wrong. Third company can hedge its interest rate risk by buying interest rate futures now in order to sell them at a later date is also wrong. Is also wrong. Because if you have a good understanding of futures, so futures move inversely compared to the normal interest rate in the markets. Okay. So if market interest rate is 5, so future interest rate will be 95, for example. If it is 95, for example, if this is 5, the normal market interest rate is 5%. So the future rate, for example, is 95. So it says that the interest rate will rise. They have a danger that interest rate will rise. So if interest rate goes up, right? If interest rate goes up, maybe 7, maybe 8. So remember, the future rate moves inversely to the actual market rate. It moves inversely to the actual market rate. So as a concept, just keep this in your mind in very short way. If interest rate goes up in the actual market from 5, so the forward rate will go down. Sorry, not forward. The future rate will go down. The future rate will go down. It's the inverse relationship. One you have actual market rate, one you have future rate. So if actual market rate goes up, future rate goes down. So now it says that you buy the futures now. Now if you buy futures at 95, so when the actual market rate goes up from 5, so the future rate will go down, which means then you have to sell the future at a lower rate. So you are buying at a higher future rate and you are selling at a lower future rate, and that is giving you a loss, because future contract requires you to complete the transaction by buying and selling. If you buy first, you have to sell. And if you sell first, you have to buy it. So the concept is important. And that is, just remember, for interest rate futures, I am telling you, it has an inverse relationship compared to the actual market rate. So if actual market rate goes up, future rate will go down. Keep this in your mind. Okay. So if you buy the futures now, so in future what will happen? For example, actual market rate of interest went up, so future rate will go down. So if you buy at 95, you need to sell at something less than 95, and this will be a loss for you because you bought expensive and sold for a cheaper rate. So this option is not right. See, it's not a guesswork that I'm doing here. Okay, so it's a wrong option. And my assumption in this that you know the concept, because I do cover this in my online classes, I expect others to cover as well. So if you know the concept, this explanation is enough. Last, taking out variable rate overdraft will allow herd company to hedge against interest rate through matching. Now, what is the concept of matching first of all? Matching means you need to match floating assets with floating liabilities and fixed assets with fixed liabilities. This is the concept of matching. Now, if I go back to the scenario, so they say that the interest paid on loan notes is at variable, that's fine. Variable is floating based on LIBOR. So it's floating, right? LIBOR, London Interbank Offered Rate. So as far as the floating to be matched with floating is concerned, that's okay. Again, it says that taking out a variable rate of overdraft. Okay, floating matched with floating, it's right. But according to the situation, it's not matching because asset needs to be matched with liability. Floating asset needs to be matched with liability. So taking out an variable rate overdraft is again a loan, and the loan that you have taken above is also a loan. So for you, it's not asset, it's a liability. So liability add on with liability is not matching. Matching says when you give loan to someone, so that is an asset for you. But if you take loan from someone, that is a liability for you. Okay? So it's not matching. You are not matching asset with liability. Plus it's overdraft, which itself short term, and the loan that you took is of 10 years. So that's too much long term. So it's a wrong option again. So the correct is the one A, but every statement required a very good conceptual understanding, which I made sure I gave by explaining you slowly, and I tried my best to make it simple and simple for you. So I hope I've succeeded in this, and this is clear to all of you. Thank you very much, guys, for attending this 3-day webinar. Now, important things I need to tell you people here. Remember, is the mock package we are announcing tomorrow on WhatsApp group. It's a paid one. This will include mock with individual feedback by the tutor, which is important. You should know the mistakes. We'll give you the feedback. Plus, expected topic videos. Expected topics which I think have a good chance of coming in March 21. You will get the pre-recorded videos of those as well. So you can cover up the things if you are not good here. Okay? If you realize in the webinar you are lacking somewhere, you can enter in this package and you get 2 best things for 1 week along with tutor support till the end. The other free thing coming up is the grand revision. It's free. We'll share the details of this as well on the WhatsApp group. If you're not part of the group, please send me the message. I'll share the group link with you people. Okay?